We've heard time and time again, fear-mongering people have been saying that China's banking and financial system is nothing but a fraud, and it will soon collapse. Many critics say that China has been lying about its economic data, while others argue that the country's reliance on a debt-fueled economy is unsustainable. Yet, despite these warnings, China's banking and financial system is massive. It may even be so massive that it can be referred to as a too-big-to-fail type of system. Furthermore, the Chinese banking system is intertwined with the Chinese government, which basically means that if there were any crisis, the government can immediately step in to fix it. So, knowing that, does it really mean that China's financial system has little or actually no risk of failing? Is it too big to fail? Well, to understand this, let's first have a brief introduction into what it really means to be too big to fail. Back in 2008, many of you may already know that a global crisis unfolded. This led to the collapse of Lehman Brothers, which was coined as a too-big-to-fail institution. Lehman Brothers was not just a small company, it was massive. Here's a graph on the total assets of Lehman Brothers. In 2008, the company had total assets of over $691 billion. It wasn't the largest bank at that time. But you got to understand that $691 billion in 2007 is the equivalent to over $1.04 trillion today when adjusted for inflation. Yet, that very company failed. China, on the other hand, is quite unique. Its banking and financial system is dominated by enormous state-controlled banks and other financial institutions that have been built up in tandem with the country's rapid industrial and urban expansion. But you wouldn't really understand just how big China's financial system is until we actually try to find out what their assets are. A bank's assets are simply the total value of what it owns or controls, including loans it has given out, investments, and reserves. This is how you can know how valuable a bank is. The more their assets would simply reflect just how much they control in terms of financial resources. And when we look at China's biggest banks, the numbers are staggering. Here's a graph on the largest banks in the entire world by total assets. Yes, this is a list of the world's largest, not just in China. As you can see, the world's largest banks by total assets aren't actually American companies, nor are they European ones, but rather Chinese banks. Here in the list, you see the ICBC with total assets of over $6.8 trillion, followed by the Agricultural Bank of China with over $6.2 trillion, then China Construction Bank at $5.8 trillion, and finally Bank of China with over $4.8 trillion. These four banks are all Chinese banks, and they surpass any other major banks around the world. This basically already puts out the fact that Chinese banks are massive. They far outshadow what Lehman Brothers was, or in fact outshadow any size of any American company. Furthermore, what you should know is that these major banks aren't only intertwined with the Chinese government, they are actually owned and controlled by the government. This ownership gives the Chinese government unparalleled power to influence and manage the banking system directly. Unlike in the US, where banks operate with significant independence, China's major banks are essentially extensions of state policy. This means that when problems arise, the government doesn't just act as a regulator, it acts as the owner, with full authority to make decisions that can stabilize the system. But of course, there are still risks to China's overall financial systems. No company is safe from being too big and not failing. That is a given due to the collapse of the Lehman Brothers. So, what kind of risks can China's financial system face? Well, there's a concept called non-performing loans, NPLs. Non-performing loans are loans in which the borrower has stopped making the required payments, either interest, principal, or both, for a certain period, typically 90 days or more. In simpler terms, these are loans that are unlikely to be repaid. Non-performing loans are a big deal because they reflect the health of a bank's balance sheet. The more NPLs a bank has, the more financial stress it faces, as it's not getting the money back that it lent out. So, just how much non-performing loans do Chinese banks face? Well, official data from the National Financial Regulatory Administration shows that as of the second quarter of 2024, the non-performing loans of China sits at 3.3 trillion yuan, which is just roughly $460 billion. That's not really a lot. Here's a graph on the bank non-performing loans to total gross loans. This data represents the percentage of all loans that are classified as non-performing compared to the total amount of loans given out by banks. In simple terms, it shows how much of the money that banks have lent is at risk of not being repaid. This ratio is important because it helps us understand the health of the banking system. A higher percentage means more bad loans, which indicates financial stress, while a lower percentage suggests that most loans are being repaid as expected. Here, you can see that China's bank non-performing loans have just been around 1.7 to 1.8%. That, too, is very small. It's a figure that is smaller than many developed economies. Economies like Italy and Spain are much higher than China. Now, it's small. But there's more risks out there, so we can't conclude immediately that it's all good. So, let's talk about another problem, which is the special mention. Here's a graph on the non-performing loans, as well as the special mention loans. Here you can see that China's risky bank debt is more than $1 trillion. But what are special mention loans? Well, they are loans where the borrower is currently able to repay the principal, interest, and income. However, certain factors exist that could potentially weaken their ability to meet these repayment obligations in the future. This special mention category includes credit extended to struggling property developers and cash-strapped local governments. Or put it simply, they are loans that aren't bad yet, but could turn bad soon. Think of them as a warning sign. Borrowers are still paying, but there are red flags that they might not be able to keep it up. But despite this, it is still just 4% of total lending. But as we will continue to mention, there's loads of other problems that still stand. One problem is the fact that the commercial bank's net interest margin has been dropping. Here's a graph on that matter. Here you can see that as of the latest data that we acquired for the second quarter of 2024, net interest margin has been at its lowest at just 1.54%. What this simply means is that banks are making less profit from their core business of lending money. The net interest margin, NIM, measures the difference between what banks earn from loans and what they pay out in interest to depositors. A higher margin means more profit, while a lower margin means tighter earnings. At just 1.54%, this is the lowest level ever recorded for China's commercial banks. This drop signals that banks are struggling to make money, partly because of lower interest rates, slowing loan demand, and increased pressure to support struggling sectors like real estate. Why does this matter? Well, when banks earn less, they have fewer resources to absorb financial shocks. This makes them more vulnerable to risks like loan defaults, economic slowdowns, or unexpected crises. It's like a business making less profit while expenses keep piling up. Eventually, something has to give. Now, there are still loads of other risks, but we'll stop there. Let's now talk about the past crisis and what China did. Back in 2013, China's financial system experienced an episode of stress. There was a sudden liquidity crunch in the interbank market, which sent overnight lending rates skyrocketing from around 3% to as high as 30% in a matter of days. This episode, known as the Chinese banking liquidity crisis of 2013, was a wake-up call that demonstrated how quickly a shock can destabilize even a vast system. This event highlighted the fragility of China's financial system despite its massive size. Banks were suddenly reluctant to lend to each other, fearing hidden risks, which caused a severe shortage of cash in the system. This spike in lending rates created panic because banks rely on these short-term loans to manage their daily operations. The only good part is that unlike in countries where markets are left to correct themselves, the Chinese government quickly stepped in. The People's Bank of China injected liquidity into the system to ease the cash crunch, stabilizing the interbank market. They also tightened regulations on shadow banking to reduce risky lending practices, which were a major cause of the crisis. And that's where we want to talk about why China's financial and banking system may indeed be too big to fail. Indeed, as we have shown, there are risks out there. But in all honesty, they are still small. Sure, there are risks that we haven't mentioned yet, but China's financial and banking system will survive in cases of trouble simply because its government will step up. The big four banks of China are almost guaranteed government backing. In any crisis scenario, Beijing is ready to step in, whether through direct capital injections, liquidity support, or asset management schemes to offload bad loans. But then again, at the end of the day, it lies on what the government would do. They could still make mistakes which can cost the economy. But anyway, do let us know what you think. Thanks for watching.